Hey everyone, and welcome back to Talk Tickers. You know, we love to get our hands dirty digging through those earnings calls, and today we're taking a deep dive into Kohl's Q4 2024 earnings call.
Oh yeah, this one had the market scratching its head.
That's for sure. So let's break it down and figure out why everyone seems so spooked by these results. To set the scene, Kohl's reported a 9.4% drop in net sales for Q4. And to add insult to injury, they ended the year down 7.2% overall.
Oof, those are some rough numbers.
Yeah, not pretty. And it gets worse. Comparable sales also took a hit, down 6.7% for the quarter and 6.5% for the whole year.
Not the kind of performance that inspires confidence.
And on the earnings front, they clocked in with an adjusted earnings per share of $1.95 for Q4, bringing the full year to $1.50. Clearly not the kind of results investors were hoping for.
Not even close, especially with the new CEO, Ashley Buchanan, the one who came over from Michael's in mid-January. Well, he didn't sugarcoat things in the call. He was pretty upfront about the need for some serious course correction.
Yeah, I noticed that too. He seemed to be pointing fingers at their merchandise strategy, specifically moving away from those core product categories and going a little too crazy with excluding brands from their famous coupons.
Seems like they tried to reinvent the wheel and ended up alienating their loyal customer base in the process.
You hit the nail on the head there. So now Buchanan's got to walk this tightrope of trying to re-engage those core customers without spooking the newer shoppers they've managed to attract with things like, Sephora. It's a tough balancing act, for sure.
For sure. So how is he planning to pull that off?
Well, he's laid out three key priorities, like the pillars of his Kohl's kingdom, right? First up is what they're calling a curated and balanced assortment. It's all about bringing back some of those categories that their core shoppers loved, things like fine jewelry and petites, but also keeping those growth areas like Sephora humming along, home decor, impulse buys, that sort of thing.
Sounds like they're trying to have their cake and eat it too. Will that even work?
That's the million-dollar question, right? Then their second big focus is all about reclaiming their crown as a value and quality leader.
I like it. Back to basics.
Exactly. So that means giving those proprietary brands a boost, simplifying those promotions, and making sure their pricing is, crystal clear.
Yeah.
No more confusion.
A little transparency goes a long way with shoppers these days.
Truth. And finally, they're really hammering home the idea of a frictionless shopping experience.
I think we can all get behind that.
Right. So that's all about consistency across their different channels, making sure those core items are always in stock, spiffing up those store layouts, and creating a more cohesive digital presence. It's about making it easy and enjoyable to shop at Kohl's, no matter how you choose to do it.
Sounds good in theory, but can they actually pull it off? Their financials paint a bit of a mixed picture, don't they?
Yeah, there are definitely some red flags waving. Digital sales took a nosedive, down a whopping 13.4% in Q4. They're trying to blame it on an inventory issue, which they claim is fixed now, but that's a pretty steep drop to just shrug off.
Yeah, 13.4%. That's not just a little inventory hiccup. Makes you wonder if there's more to the story.
Right, and then there's their guidance for 2025, which, let's be honest, doesn't exactly scream confidence.
Not exactly painting a rosy picture.
They're projecting net sales to decline between, get this, 5% and 7%, with comparable sales down another 4% to 6%. So yeah, not exactly a recipe for a quick turnaround.
Not even close. And those operating margins, they're projected to be somewhere between 2.2% and 2.6%, with earnings per share landing between $0 and $16.16.
Wait, that EPS range is huge? Like, are they even sure what's going on?
Well, it reflects the uncertainty they're facing. There's a lot of internal restructuring and implementing changes to be done, not to mention that the overall economic environment is, well, let's just say unpredictable.
Speaking of the economy, Buchanan talked about this growing gap between different income levels. He pointed out that consumers making under $100,000 are feeling the squeeze from inflation more than anyone else.
Makes sense. That tracks with what we're seeing across the board. Consumers are being a lot more careful with their spending these days.
Absolutely. So Kohl's is trying to batten down the hatches, cutting costs, and tightening their belts. They already shut down 27 underperforming stores and one of their e-commerce fulfillment centers just last quarter.
Trying to trim the fat wherever they can.
Yep. And to free up even more cash, they've also slashed their dividend to a measly 0.125 place per share.
Ouch. That'll get investors' attention.
You think? But they're still planning to make some strategic investments.
I was just thinking that. Where are they putting their money?
The bulk of their capital expenditure budget, which is somewhere between $400 and $425 million, is going towards wrapping up that Sephora rollout expanding those impulse buy areas in stores, and of course, beefing up their omni-channel capabilities.
So basically doubling down on what's working and investing in areas that align with those key priorities we talked about.
Makes sense, right? Seems like a pretty sensible strategy on paper, but can it really save them from the storm that's brewing? I mean, is it enough to turn the tide?
That's the big question mark hanging over all of this. They're definitely making moves, trying to right the ship, but this turnaround, it's going to take time, and there's no guarantee of success.
You're not painting a very optimistic picture.
Well, investors need to brace themselves. This could be a bumpy ride.
So we've got the financials laid out, their strategic priorities are on the table, and we've got a pretty good grasp of the challenges they're up against.
We set the stage.
Now, before we dive any deeper into those details, I think it's time for our favorite segment, the one where we throw caution to the wind and let our imaginations run wild. It's time for This Is Not Financial Advice.
I always love this part. Let's cook up some out-of-the-box trade ideas.
All right, so given everything we've just discussed about Kohl's current predicament, what kind of crazy yet plausible trades are swirling around in that financial brain of yours?
Well, first of all, we've got to acknowledge that a company in turnaround mode like this, it's going to be volatile. That stock price could swing wildly depending on how investors perceive their progress or lack thereof.
Yeah, you're right. It's a high-risk, high-reward situation.
Exactly. So, hear me out. What if we short Kohl's stock against a basket of retailers who are, shall we say, better equipped to handle the current market?
You're thinking a classic long-short strategy. Interesting. But who would we put in this basket? Who are these retail titans that are seemingly immune to all the problems Kohl's is facing?
That's where the real fun begins. We need to find those retailers with a rock-solid value proposition, a killer e-commerce platform, and a knack for adapting to those ever-shifting consumer trends. They need to be masters of efficiency, value perception, and delivering an exceptional customer experience.
So basically everything Kohl's is struggling with at the moment.
You got it. The whole idea is that these other retailers will continue to outperform Kohl's in the coming quarters, and that's what's going to create that divergence in their stock prices.
It's a classic relative value play. But it all hinges on the assumption that Kohl's turnaround is going to be, well, a bit of a slog.
That's the bet we're making. But of course, this is all hypothetical, just a little thought experiment to get those gears turning.
Of course. We're just having a bit of fun here. Definitely not financial advice. So don't go running out to short Kohl's based on our rambling.
Absolutely. Do your own research, folks, and talk to a financial professional before making any investment decisions. But it is fun to play around with these what-if scenarios, isn't it?
It sure is. And who knows, maybe some Wall Street hotshot is listening right now and taking notes.
Maybe so. But for now, let's bring it back down to earth and continue our deep dive into Kohl's Q4 earnings call. We've laid the groundwork. Now it's time to dig deeper.
I'm ready for it. Let's see what other gems we can unearth.
Remember earlier when we were talking about how their digital sales just totally tanked, down 13.4% in Q4? Well, it really goes to show you how much a simple thing like inventory can have a ripple effect and really mess things up.
Yeah, it's like one thing leads to another, right? You've got inventory problems that lead to missed online sales, and that puts the squeeze on margins, and bam, earnings take a hit.
Exactly. And you know what else? That whole domino effect might be a big part of why they decided to slash that dividend. It's like they're sending a message that right now, financial stability and building up that cash reserve is priority number one. Everything else takes a back seat.
Like, hey, we need to fix this mess before we even think about rewarding shareholders.
Exactly. And you know what else I find really interesting? Their capital expenditure plan, that tells a story too.
What's catching your eye there?
Well, the fact that they're still pouring a ton of money into that Sephora rollout tells me they're all in on that partnership. Like, they really believe in it.
Well, it's working for them, right?
Yeah.
Sephora's their golden goose right now.
Yeah.
It's bringing in new customers and boosting sales. They even mentioned that comparable beauty sales picked up in Q4, which is pretty impressive considering, the overall retail climate.
Yeah, that's saying something. It shows Sephora is bringing something special to the table. Doubling down on a winner makes sense to me.
Agreed. But what about those other investments they mentioned? Expanding those impulse buy areas in stores and, all that omni-channel stuff. What's the game plan there?
Well, if you connect the dots, it seems like they're trying to create a more engaging and convenient shopping experience overall.
So basically, tempting those shoppers to spend a little extra once they're already in the store and making it super easy to shop, no matter if it's online, in-store, on their phone, the whole 9 yards.
You nailed it. It's a win-win for them, right? Potentially boosting sales while also meeting the expectations of today's, savvy shopper.
It's a solid plan on paper, but will it be enough to outweigh all the other stuff they're dealing with? That's the big question mark.
Yeah, that's the multi-million-dollar question, right? They're doing things, taking steps, but there's still so much uncertainty surrounding this turnaround.
And that uncertainty is written all over their super cautious guidance for 2025, wouldn't you say?
It is. One thing I found really interesting in the Q&A was how they talked about their credit business.
What do they have to say about that?
They basically admitted that the reason their credit sales are down is directly tied to how much they've been struggling with their core customer base.
You mean those loyal shoppers who felt kind of betrayed by some of the changes Kohl's made? So those same shoppers are also pulling back on using their Kohl's credit cards.
Exactly. It's like everything's connected. Those missteps with their core customers, they seem to have messed things up in multiple ways.
It makes you wonder how much damage was really done and how long it's going to take to really fix those relationships.
It's a valid concern, right?
Yeah.
Rebuilding trust, it takes time and consistent effort.
And speaking of time, Kohl's keeps saying this turnaround isn't going to be an overnight thing, right?
Absolutely. They kept repeating that phrase, multi-quarter journey, over and over again. It's like they're telling investors, hey, buckle up. This is going to be a long ride.
No quick fixes on the horizon. Got it.
No. And that's something I think our listeners should really take to heart. If you're thinking about investing in Kohl's, you got to have that long-term vision and be prepared for some bumps along the way.
Definitely not a stock for the faint of heart.
You can say that again. Thinking back to that "this is not financial advice" segment, I'm still thinking about that long-short strategy you pitched.
Oh, yeah. Let's put those imaginary hedge fund hats back on.
All right, so you were saying we should short Kohl's and then go long on a basket of retailers who are in a better position to handle the current, market craziness. But what kind of retailers are we even talking about here? Who would be in that basket?
Imagine this. You and I are hotshot analysts pitching this idea to our portfolio manager, the one with the deep pockets.
Yeah.
We're in one of those fancy conference rooms with the glass walls, and I'm at the whiteboard. Okay, so we're shorting Kohl's because we think they're going to keep struggling, right?
Okay, I'm with you.
Now, on the long side, we need retailers that are basically killing it, right? The ones with a strong value proposition, an amazing e-commerce game, and a real sixth sense for what consumers want. So first things first, we're going to focus on value. We're talking about the companies that are absolute masters of offering great deals without resorting to those constant coupons and promotions. You know what I mean?
I'm starting to see a pattern here. We need companies that are super efficient and know how to make shoppers feel like they're getting a great deal.
Exactly. They've got their inventory down to a science, their sourcing is top-notch, and they know how to pass those savings on to the customer. They get it. In today's world, value is king.
Makes sense. But value alone isn't enough these days, right? They also need to have a killer online presence.
You know it. E-commerce is non-negotiable at this point. We need players who aren't just selling stuff online, they're creating a whole experience for their customers.
You're talking about those websites that are so easy to use with personalized recommendations and a checkout process that's like smooth as butter.
Exactly. Yeah. And they got to be masters of the omni-channel game, making it seamless to shop, whether you're online, in-store, on your phone, the whole shebang. Think buy online, pick up in-store, hassle-free returns, and a loyalty program that keeps people coming back for more.
It sounds like you're describing the polar opposite of where Kohl's is right now.
That's the point. And finally, we need retailers who are adaptable, the ones who can move quickly when trends change. They got to be comfortable experimenting, trying new things, and pivoting when something isn't working.
Like chameleons of the retail world, blending in and thriving no matter what's thrown at them. So who are these retail titans? Give me some names.
That's where the real work comes in, right? We got to dig deep, analyze their financials, figure out their strategies, and understand what makes them stand out from the crowd.
It's like assembling a dream team of retail superheroes, each with their own unique superpower.
And together, they form our long portfolio, the one that's going to soar as Kohl's struggles to find its footing.
But just to be clear, this is all purely hypothetical, right? Just a fun little brainstorming session.
Of course. This is just us thinking out loud. Definitely not financial advice. Don't go selling your house to short Kohl's.
Agreed. Always do your own research, folks. But it's fun to imagine, isn't it? It shows how important it is to look beyond the headlines and understand what's really happening in the retail world.
Well said. And who knows, maybe our little brainstorming session will spark some genius ideas out there.
Maybe. But for now, let's bring it back to reality and get back to our Kohl's deep dive. We've covered their numbers, their plans, and even dreamed up some wild trades. But there's still more to uncover.
I'm all ears. Let's see what other insights we can dig up.
You know, something that really struck me was how much they emphasized their efforts to win back those core customers they lost. They talked about bringing back certain categories and simplifying those promotions.
Yeah, it sounds like they're admitting they went a little too far trying to chase the latest trends and are trying to backpedal now.
Totally. It's like they're saying, hey, we messed up and we're trying to make things right.
It's a classic tale of a company losing sight of its roots and then scrambling to find its way back.
Yeah.
But is it too little, too late?
That's the question, isn't it? It all comes down to how well they execute these changes and how open those core customers are to giving them another chance.
It's not easy to win back trust, especially when there are so many other options out there.
You're telling me. And it's not just a Kohl's problem. A lot of retailers are dealing with the same dilemma: how to attract new customers without alienating the ones they already have.
It's a tough balancing act.
For sure. It just goes to show how important it is to know who your target customer is and make sure your strategies are in line with what they want.
They were also talking a lot about reestablishing their value proposition. What was their take on that?
They were hammering home the message that they're committed to offering good quality at great prices. They talked about making their private label brands better and simplifying their pricing strategy.
So back to basics, essentially.
Yeah, in a way. They want shoppers to think of Kohl's as the place to go for value, you know?
But how are they going to stand out when there are already so many other value retailers out there? It's a crowded market.
That's a good point. I think that's where their focus on creating a really good, easy shopping experience comes in.
They talked about improving their omnichannel stuff and making their stores easier to shop in, right?
Right, they're trying to create an experience that's more than just about low prices. They want to build a brand that people actually like and trust.
It's a smart move, but execution is everything, wouldn't you say? Retail is tough, the margins are thin, and what shoppers want is constantly changing.
You're not wrong. Kohl's has got their work cut out for them.
They do, but let's not forget they're not starting from scratch, right? They've got history, a pretty big customer base, and a recognizable brand.
That's true. They've got a foundation to build on. The question is, can they use what they've got to overcome their weaknesses and make this turnaround happen?
That's what we're all waiting to see.
Exactly. And something they kept coming back to was how inflation is changing the way people shop. They really highlighted how people making less than $100,000 are feeling the pinch, and that's having an impact on the whole retail landscape.
We're seeing that everywhere. People are watching their wallets a lot more carefully.
You got it. And how retailers adapt to that is going to be key to their success.
So what's the secret sauce? What do retailers need to do to thrive in this new reality?
First things first, they've got to double down on value. That doesn't necessarily mean having the absolute lowest prices, but it does mean offering good quality at a price that makes sense.
It's about making shoppers feel like they're getting a good deal.
Exactly. And they need to be laser focused on efficiency, streamlining their operations, getting their inventory just right, minimizing waste. It's all going to be crucial for staying profitable in this kind of environment.
Doing more with less. That's the name of the game.
And finally, they need to get really good at personalization. Understanding what their customers want and need is more important than ever.
So basically using data and technology to tailor those shopping experiences and make people feel like they're being seen and understood.
Exactly. In today's world, the retailers who can deliver value, efficiency, and that personal touch, those are the ones who are going to come out on top.
Those are some great insights. Now, are you ready to tackle the Q&A portion of this call? I always find it fascinating to hear what kind of questions the analysts are asking and how the company responds.
Let's do it. The Q&A often reveals more about a company's strategy and the challenges they're facing than their prepared remarks.
Absolutely. So kicking things off, we have Mark Altsweger from Baird. He wanted to know the new CEO's take on the merchandise strategy. What's working, what's not, and what are the biggest opportunities for change?
It's a natural starting point. Investors are always eager to hear the new CEO's vision for the company.
And Buchanan didn't shy away from the tough questions. He straight up admitted that Kohl's made some mistakes, especially when it came to straying from those core product categories and excluding too many brands from their promotions.
It's like they're finally acknowledging that they lost sight of their core customers in an attempt to chase after shiny new trends.
And he really emphasized the need to win back those loyal shoppers without alienating the newer ones they've managed to attract. It's a tricky balancing act for sure.
No doubt about it. Altschwager also asked about the potential impact on their margins, especially with their plans to improve the quality of their private label brands and include more brands in their promotions.
Yeah, margins are always a big concern for investors, especially in the retail world.
Absolutely. And Buchanan acknowledged that there's a trade-off involved. Making those private label brands better can be more expensive, and including more brands and promotions could potentially cut into their profits.
So it's all about finding that sweet spot, right?
Yeah.
Delivering value to customers without sacrificing profitability.
They talked about optimizing their promotions and allocations to strike that balance.
So they're trying to be more strategic with their promotional spending.
Exactly. Now, next up we have Dana Telsey from the Telsey Group. She had a two-part question all about their stores and their merchandise.
What about those stores? What was she getting at?
Well, with all those recent store closures, she wanted to know what the CEO's overall vision for their physical stores is and why they chose to close the ones they did.
It's a hot topic, right? The whole debate about the future of brick and mortar retail. Are physical stores going extinct, or are they still relevant in the digital age?
That's the billion-dollar question. And Buchanan's answer was pretty interesting. He made it clear that most of their stores are actually profitable, and that closing those specific locations was more about getting rid of the ones that weren't performing well. It wasn't about moving away from physical stores altogether.
So they're not abandoning brick and mortar, they're just being more picky about which stores they keep open.
Right, they're trying to streamline their operations. Now, what about her question on the merchandise assortment?
She wanted to know what the CEO's grand plan is for their product mix, especially after all the changes they've made lately.
It's been a bit of a whirlwind with the merchandise, so it's natural to wonder what direction they're heading in.
And Buchanan kept stressing the importance of balance. He wants to cater to both their loyal customers and the new shoppers they've been trying to win over.
Trying to please everyone, that's a tough game to play.
It is. But he also talked about using data to guide their decisions. They're using analytics to track what's selling well and adjusting their offerings based on that. So it's not just about guessing what shoppers want. They're using hard data to back up their choices.
Smart move. Telsey also asked about Buchanan's perspective on the Kohl's customer and how their behavior is evolving.
It's all about knowing your customer, right?
Absolutely. And Buchanan went back to his point about how inflation is impacting spending, particularly for those earning less than $100,000. He's definitely paying attention to the fact that shoppers are getting more and more price conscious.
It's a trend retailers can't afford to ignore. And Kohl's is trying to keep up. They're pushing that value message, focusing on quality, and making it easy to shop with their omnichannel strategy. They want to appeal to those budget-conscious shoppers.
Seems like a solid plan. Now, moving on to Oliver Chen from TD Cowen, he had a multi-part question all about the timeline for their plans, the challenges they might face, and how supply chain issues could impact their value proposition.
Okay, let's break that down. What was he asking about first?
He wanted to know the order of operations. Which initiatives are they going to tackle first, and which ones are going to take a little longer to roll out?
Investors want to know what the roadmap looks like.
Exactly. And Buchanan was upfront about the fact that some of these changes, especially the ones related to their merchandise strategy, those are going to take a while. It's not like flipping a switch.
The fashion industry moves at its own pace.
It does. But he also pointed out that there are some things they can do quickly, like tweaking their promotions and making their stores run more smoothly.
So a mix of short-term wins and long-term projects.
Exactly. Then Chen asked about the potential roadblocks they might hit along the way.
Turnarounds are never a walk in the park. What did Buchanan say about that?
He was pretty realistic. He admitted that winning back lost customers can be really tough, and there's no guarantee it'll work.
So a healthy dose of honesty, but still optimistic.
Exactly. And he also talked about how hard it is to manage costs when everything's getting more expensive.
It's a tough balancing act. They need to invest in this turnaround, but they also can't let costs spiral out of control.
You got it. Chen's last question was about how the speed and flexibility of their supply chain ties into their ability to deliver value to customers.
Interesting angle.
Yeah.
What was Buchanan's take on that?
He stressed how important it is to have a diverse and agile supply chain, especially with all the craziness we've seen lately.
It feels like things are getting more and more unpredictable all the time.
You're not wrong. And Buchanan said that Kohl's has been working on diversifying their suppliers and making their operations more flexible.
So they're not putting all their eggs in one basket.
Exactly. They're also using technology to get a better view of their supply chain so they can react quickly if there are any sudden changes in demand or disruptions in the market.
Smart move. Minimize that risk and make sure they can deliver on their value proposition consistently.
Exactly. Next up is Michael Benetti from Evercore. He had a three-part question all about Sephora, those issues with their core customers, and their promotional strategy.
Let's break it down, starting with Sephora. What did he want to know?
He was curious about the outlook for Sephora, both in terms of same-store sales growth and new store openings.
Sephora's been their biggest success story lately, so it makes sense that analysts want to hear more about it.
Absolutely. And the management team basically said they expect Sephora to keep performing well, although they did say that the boost from new store openings will be smaller this year as they finish putting Sephora shops in all their stores.
Makes sense. The initial excitement of those new stores opening will naturally die down as they reach their limit.
Exactly. Now, what about his question about the friction with their core customers?
He wanted to know the specifics of how Kohl's managed to alienate those loyal shoppers.
That's a key part of the story, right? Understanding how they lost those customers is essential to figuring out how to win them back.
And they actually gave some concrete examples. They talked about getting rid of popular categories like fine jewelry and petites and excluding way too many brands from their coupons.
It sounds like they made some major changes that didn't go over well with their loyal base.
They did. And now it seems like they're realizing they might have gone a little overboard trying to chase those new trends.
It's a lesson for any business. Don't forget about the people who helped you get to where you are.
Absolutely. Now, Benetti's last question was about their promotional strategy. He wanted to know how they plan to make those promotions more effective and make sure those savings are actually getting passed on to the customer.
It's a tricky balance, right? Offer good deals, but don't kill your profits.
Exactly. And the management team talked about taking a more targeted approach with their promotions, focusing on products that will actually drive sales and appeal to their target customer.
So be more strategic with those promotional dollars.
Exactly. They're also looking at ways to simplify their promotions so they're easier for shoppers to understand.
No one wants to spend an hour deciphering coupons.
Exactly. Now we have Ashley Helgens from Jefferies. She had a two-part question all about consumer health and the CEO's vision for the balance between their own brands and those big national brands.
Okay, starting with consumer health. What was her question there?
She wanted to know what assumptions they're making about consumer spending in their guidance for the year. Basically, how optimistic or pessimistic are they feeling about the average shopper?
That's a big factor, especially these days.
And they admitted that there's a lot of uncertainty surrounding the consumer, especially with inflation still hanging around. They're not getting their hopes up.
Makes sense.
Yeah.
They're expecting consumers to stay focused on value and are prepared for some unpredictable spending patterns.
Sounds about right. What about the private label versus national brand question?
She wanted to know the CEO's long-term vision for that balance. How much will they rely on their own brands versus those big names everyone knows?
That's a fundamental question for any retailer.
It is, and Buchanan's answer was interesting. He basically said he doesn't believe in setting specific targets for how much of their merchandise should be their own private label stuff.
So it's not about hitting a certain percentage. It's about offering the mix of products that their customers want.
Exactly. It's all about the customer, letting their preferences guide the decisions.
A very customer-centric approach.
You got it.
Oh.
And it shows he's serious about understanding their target audience and catering to them.
Makes sense. Now let's hear what Chuck Grom from Gordon Haskett had to say. He had a two-part question focusing on regaining traction with those lost customers and the thought process behind those recent store closures.
Let's start with the challenge of winning back those shoppers. What did he ask about that?
He acknowledged that it's a tough and time-consuming process and wanted to know what specific steps Kohl's is taking to make it happen.
It's the question on everyone's mind.
Absolutely. And they highlighted a few key areas. They're working on rebuilding their private label assortment, bringing back some of those popular categories they got rid of, and making their promotions less complicated.
So basically, they're trying to fix the things that push those customers away in the first place.
Exactly. Trying to undo the damage and show those shoppers that they're listening.
Let's hope it's not too little, too late.
Only time will tell. Grom also asked about those store closures. He was curious why they didn't close more stores, especially considering how many other retailers have been shrinking their footprint.
Yeah, store closures are becoming pretty common these days.
They are. And the management team emphasized that most of their stores are actually profitable, and that the closures were more about getting rid of the underperforming locations, not about moving away from physical stores in general.
So they're not giving up on brick and mortar, just trying to make sure they have the right stores in the right places.
Exactly. Now let's move on to Matthew Boss from JP Morgan. He had a two-part question all about the state of their inventory and their cost structure.
Okay, starting with inventory. What did he want to know?
He was interested in the overall health and makeup of their inventory at the end of the fourth quarter.
Inventory management is crucial in retail. Too much inventory can lead to markdowns and hurt their bottom line.
Absolutely. And the management team said they're feeling pretty good about their inventory situation. They've been working on rebalancing their assortment to better match what people are actually buying.
So no major warning signs there.
Not yet. Boss also asked about their cost structure and what their plans are for cutting costs further.
Cost control is always important, but especially when the economy is shaky.
You're telling me. And they highlighted a few areas where they're still finding ways to save money. They're optimizing their store operations, trimming their marketing budget, and using technology to do things more efficiently.
It's a multi-pronged approach to keeping those costs in check.
Exactly. Now let's hear from Brooke Roach from Goldman Sachs. She had a two-part question focusing on their plans to stop excluding so many brands from their coupon programs and how their credit card business is doing.
Okay, let's start with those brand exclusions. What did she ask about that?
She wanted to know how they plan to reverse those exclusions and what kind of conversations they're having with the brands.
That's a big part of their plan to win back those loyal customers they lost.
Absolutely. And they said they're taking a look at all their brand exclusions and are working to get rid of the ones that were implemented without the brands even asking to be excluded.
So the ones where the brands didn't actually say, hey, we don't want to be a part of your promotions.
Exactly. They're trying to make their promotions simpler and more appealing to shoppers.
It's a step in the right direction. Now, what about her question on the credit card business?
She wanted to understand how the credit card business is performing, but taking out the effects of that accounting change they mentioned.
It's important to look at the underlying trends, right? See what's really going on.
Absolutely. And they admitted that their credit card business has been a bit weak, which they're blaming on the struggles they've been having with their core customers.
Makes sense. Those loyal shoppers who are spending less at Kohl's in general are also using their Kohl's credit cards less.
It's more proof that those strategic missteps had a ripple effect throughout their business.
It really is. And it shows how crucial it is for Kohl's to rebuild those relationships with their core shoppers.
Well said. We've covered a lot of ground today. Their financials, their strategic priorities, the management team's insights, and even some hypothetical trades.
It's been a deep dive, for sure.
It has. We've learned a lot about the challenges and opportunities in front of Kohl's as they try to pull off this turnaround.
Absolutely. But there's still more to explore.
You know it. Let's move on to our final segment where we'll wrap things up and share our key takeaways with our listeners. Okay, so we've spent a good chunk of time dissecting Kohl's here. I think it's time to zoom out and see the big picture.
Yeah, let's boil it all down.
What are the main takeaways you think our listeners should walk away with from this deep dive?
Well, I think the most important thing is that Kohl's is at a crossroads. They're admitting they messed up, especially when it comes to their core customer base and their overall merchandise strategy.
So they went chasing after trends and forgot about the people who got them to where they are.
Exactly. And now they're trying to turn things around, but they're making it clear that it's going to be a long, slow process.
No quick fixes. Got it.
Nope, not a chance. Their guidance for 2025 is pretty telling. They're projecting sales declines, maybe some slight margin improvement, and a huge range for potential earnings per share. It's all a bit up in the air.
Lots of unknowns right now. They're dealing with a shaky economy, tons of competition in the retail world, and the internal headaches of actually making all these changes they've announced.
It's a lot to handle, but hey, it's not all bad news. There are some bright spots.
Yeah, Sephora is still their golden child, bringing in new customers and racking up some decent sales growth.
And their renewed focus on value and quality, plus that commitment to a smooth omni-channel experience, that could really appeal to shoppers, especially with how things are going economically.
It's a solid plan, but can they pull it off? Can they actually deliver on these promises and rebuild that trust with those loyal customers they lost?
That's the million-dollar question, isn't it? It's a huge challenge, but not impossible. They do have some things going for them, a long track record, a well-known brand, and a customer base that used to be incredibly loyal, even if they're feeling a bit jaded right now.
So it'll be interesting to see how this all unfolds. Kohl's is at a turning point, and the decisions they make in the next few months and years will make or break them.
No pressure, right? But yeah, it's definitely going to be a fascinating story to follow. We'll be keeping a close eye on things here at Talk Tickers, analyzing their earnings calls and giving you the inside scoop.
You know we will. So make sure you're subscribed to Talk Tickers, where we break down those earnings calls so you don't have to.
And as always, just a friendly reminder that this is not financial advice.
We're just two people who love finance and like sharing what we've learned.
And sometimes we like to throw around some wild trade ideas just for fun.
Of course. Now, if you're a Kohl's shopper and investor, or just someone who enjoys a good retail drama, we want to hear from you.
Head over to our website or social media and let us know your predictions for Kohl's. Will they succeed? Can they become a retail giant again? We're all ears.
We love hearing from our listeners and getting your take on things.
So until next time, happy investing. And don't forget to do your own research.
We'll be back soon with another deep dive into the world of earnings. Stay tuned.